Welcome to Tesla Daily. Here's the latest on Tesla. First up, Tesla is suing the California DMV over a ruling about their full self-driving claims. They're also facing an extended deadline to submit data on that same FSD feature. In other news, the Tesla Model Y L has been approved for sale in Australia. And to boost sales, Tesla has cut prices on the Cybertruck. Interestingly, despite a decline in the overall EV market, Tesla's market share is actually rising. It seems their growth now hinges on execution, not just hype. Lastly, production for Tesla's Cybercab is getting close to launch. Stay tuned for more updates. First up, let's dive into Tesla's latest move. They're suing the California DMV over a ruling that claims they were misleading about their full self-driving, or FSD, capabilities. This lawsuit is a big deal. It touches on the ongoing debate about how autonomous driving technologies are marketed, and it could really impact Tesla's future, especially as they look to shift towards a robo-taxi business model. The DMV labeled Tesla a false advertiser because they felt terms like autopilot and full self-driving misled consumers about what their driver assistance systems can actually do. This ruling came after a lengthy investigation that started back in 2021. By December 2025, they concluded that Tesla's marketing practices were indeed misleading. Tesla has already adjusted their marketing language to comply with the DMV's demands, showing they take this seriously. But now, they want to clear their name. This legal battle is crucial, especially since Tesla's future hinges on the success of its autonomous driving tech, which is key to its valuation and growth strategy. With 1.1 million FSD subscribers, any acknowledgement of misleading advertising could shake investor confidence. And let's not forget, Tesla is already dealing with other legal challenges related to its autopilot system. They recently faced a $243 million verdict in a fatal crash case. So this lawsuit against the DMV is a pivotal moment that could shape Tesla's narrative around autonomous driving. Next, Tesla has received an extended deadline from the National Highway Traffic Safety Administration, or NHTSA, for submitting data on traffic violations linked to its FSD system. This extension, now due by March 9, 2026, highlights ongoing safety concerns. The NHTSA's investigation started in October 2025, connecting 58 incidents, including crashes, to the FSD system. Tesla has cited the challenge of reviewing thousands of records as a reason for the delay. As they expand their robotaxi service, this investigation could have serious implications. Public perception and investor confidence are at stake, especially since Tesla's market share in the EV sector recently surged to 61%, despite a broader market decline. The pressure is on Tesla to deliver accurate data. Their FSD system is central to their growth strategy, and the NHTSA's scrutiny emphasizes the intersection of technology, regulation, and public safety in the world of autonomous vehicles. Now, let's talk about the Tesla Model Y L. It's officially approved for sale in Australia. This 6-seat, extended-wheelbase version marks a significant expansion for Tesla. It shows their commitment to family-oriented consumers and positions the Model Y L as a strong contender in the growing electric SUV market, especially against competitors like the Hyundai Ioniq 5 and Ford Mustang Mach-E. With a longer wheelbase and 3-row seating, the Model Y L is designed to attract families looking for spacious electric vehicles. As Australia leans more towards electric options, this entry could boost Tesla's sales, especially after facing declining registrations. The approval follows a similar process in Europe, indicating Tesla's strategy to launch models in multiple markets at once. If the Model Y L succeeds in Australia, it could pave the way for its introduction in the US, where demand for larger electric SUVs is rising. This move aligns with Tesla's broader strategy to diversify its offerings, especially as they phase out older models like the Model S and Model X. Next up, Tesla is cutting prices on the Cybertruck to boost sales. They've introduced a new entry-level model priced at $59,990, which is a $20,000 reduction from previous models. This change comes as Tesla faces declining sales and increased competition in the electric pickup market. The price cut aims to attract buyers who were put off by the earlier high price, but there are trade-offs, like the removal of some premium features, which might affect how consumers perceive the value. Tesla's aggressive pricing strategy is part of their history of competitive pricing to capture market share. As they navigate these challenges, the success of the Cybertruck's new pricing will be closely watched by investors and analysts. This decision reflects Tesla's commitment to staying competitive in a rapidly evolving market. Now, let's look at Tesla's market share. It's risen to 61% in the U.S. electric vehicle sector, up from 57% in December 2025. This growth is impressive, especially considering the overall downturn in EV sales, which dropped 30% year-over-year in January. While Tesla's sales also fell by 17%, their ability to maintain a dominant share shows strong brand loyalty. The Model Y and Model 3 continue to be top sellers, contributing to this market share growth. Analysts believe Tesla's focus on innovation, including advancements in autonomous driving and new models, will be key to sustaining this momentum. As competition heats up, especially from lower-cost EVs, Tesla's strategic decisions will be crucial for retaining and growing its market presence. Their rising market share amidst a declining EV market highlights their strong brand loyalty and effective product offerings. Finally, Tesla's growth story now hinges on execution, not just hype. Their recent stock performance shows the need to focus on delivering results. Shares are down about 10% year-to-date, facing challenges from declining sales and increased competition. Tesla's stock has been volatile, especially after an earnings report revealed a year-over-year revenue decline. Their ambitious plans for new technologies, including autonomous vehicles and robotics, require solid execution to ensure profitability. Analysts are concerned about whether Tesla can generate enough cash flow to support these initiatives. The recent price cuts on the Cybertruck and the introduction of new models indicate they're trying to adapt, but the real test will be if these strategies lead to sustained sales growth. Investors are watching closely, as failure to deliver could lead to further stock declines. Tesla's growth narrative is at a critical point. Execution will be key to their future success. As they navigate a challenging market, delivering on their promises will be essential for maintaining investor confidence and market leadership. And speaking of leadership, Tesla's Cybercab production is nearing launch. This fully autonomous vehicle is currently being tested at Gigafactory, Texas, signaling that production is just around the corner. The Cybercab is a crucial part of Tesla's strategy to lead in the autonomous vehicle market. It's designed without traditional controls, like steering wheels or pedals, aiming to redefine personal mobility. As they prepare for production, meeting regulatory standards and consumer expectations for safety will be vital. With Tesla's recent launch of a robotaxi service in Austin, the Cybercab's introduction could enhance their position in the autonomous vehicle landscape. However, ongoing scrutiny of Tesla's self-driving technology adds pressure to ensure the Cybercab meets safety and performance benchmarks. The impending launch of the Cybercab marks a significant step for Tesla in their pursuit of autonomous driving technology. As production nears, they'll need to navigate regulatory challenges and public perception to successfully integrate this vehicle into their broader strategy for future mobility. That's a wrap for today's Tesla Daily Insights. Thanks for tuning in. And just a quick reminder, this is for informational purposes only, not financial advice. Catch you in the next update.